and I would like to thank everyone for attending our 3 o'clock presentation for Majedi Investments. I am pleased to introduce James Dupper, Chief Investment Officer of Majedi Asset Management, and William Barlow, Chief Executive Officer of Majedi Investment. While Majedi Investments has recently graduated into the AIC Global Equity Income sector to better reflect its income potential, it retains the same core approach to investing, offering investors a portfolio of select Majedi asset management funds, while also retaining a material stake in Majedi Asset Management Company itself. The trust currently has a large allocation to UK than it has historically, and also when compared to its peers, a clear differentiator and something which will be expanded on further in the presentation by James. As a matter of housekeeping, we have around 20 to 30 minutes for the formal presentation, with a further 15 or so available for the questions. Your microphones are muted, but you can ask questions using the Q&A function, which you should be able to see at the bottom of your screen. There are quite a few people attending this presentation, so please don't be disappointed if we are unable to address every question or topic raised. All questions will be shared with the managers, and we'll do our best to get answers back to everyone if we don't touch on the topic during the session. So without further ado, I hand you over to William.
Good afternoon, everyone, and thank you very much for your interest in Majedi Investments. I'll give you a brief overview of our geographic and asset allocation, which you can see on the first page. As you can see, we have 35, since 2014, we've allocated across different funds managed by Majedi Asset Management, which gives us a broadly diversified portfolio, both by geography and by style. We also retain a stake in the fund management company, Majedi Asset Management, as David mentioned, which was founded in 2003. So if we look at the Majedi Asset Management itself, it was started, as I said, in 2003, initially specialising in UK equities, and since 2014 has broadened into global equities. The Majedi Investments, as you can see from the bottom table, we currently have an exposure of 42% to UK equities, which is considerably larger than most of our peers, as you can see from the MSCI there. I think the other thing to note is we retain a stake in the Tortoise Fund, which is an absolute return fund. We go to the next page, please, James. This just shows the recent performance of the underlying funds over the last 3, 6, and 12 months. And as you can see, the funds they've performed pretty satisfactorily. We continue to have a discount to our net assets of just over 17%, and our current yield is about 5%. So I'd now like to hand over to James Dupper. As earlier said, he's Chairman, Chief Investment Officer, and also one of the UK fund managers, who can give a great insight into the current opportunity within the UK market. Thank you very much, James, and over to you.
Thanks, William. So my brief over the next 20 minutes is to put the case for UK equities. And when Kepler asked us to do that, I really jumped at the opportunity because I think it's a really interesting time to be thinking about UK equities in terms of my credibility and indeed Majedi Asset's credibility to address this subject. I'm going to default to the figures, and what we've got here is our flagship fund, which Majedi Investments is invested in, and you can see there the cumulative per annum level of outperformance since inception is 2.4%. So good outperformance over a considerable time period. But taking a step back, just as I've showed you a long-term graph for our performance, I think in terms of setting the scene for UK equities, it makes sense really, as ever in investments, to look at a long-term perspective. Really important to look at a long-term perspective. So here, and I hope this is relatively clear to you, I've extracted from Bloomberg the chart of the UK equity market, which is in orange, and then the S&P, which is the US index, obviously in white. And you can see those indices move broadly in lockstep until 2015 or so, 2016, when obviously something happened. Now, if we look at it through another lens, and here what I'm doing is showing a slightly shorter time period. So this is from 2016 onwards, and this is comparing again the all-share, the UK index in orange against the MSCI World, which is the global index. And here again, you can see the jaws open up. Next, in terms of thinking about the valuation of UK equities, it's important to consider both the exchange rate and then obviously the tenor of the economy. Now, in terms of the exchange rate, here what I've done is I've shown sterling against the US dollar back to 1990, again, a long-term perspective. And, you know, the interesting thing is obviously, as you know, cable, as in sterling dollar, is about 138 or so at the moment. Now, actually, if you take the premise that often if relative exchange rates in different countries have roughly the same inflation level, you know, they should broadly equalize over time. Yes, there'll be institutional issues, etc., but that's not a bad assumption. Why I say that is if you actually do cumulative inflation for the US over the period 1990 to the present, it is actually 105%, so 105%. For the UK, it's 104%, okay? So inflation is photo finish. Then if you look at the average of this graph that I've shown here, actually it's 160. So why I put this in is just to challenge, if you like, what I think is the consensus that sort of sterling's had its bounce. You know, the average over that period is actually 160. Then if we look at the next graph, which is it's a measure which Citigroup does, which essentially what it does is it takes any statistic that was released. So let's say yesterday in the UK, the manufacturing index was released. That came in a little bit better than expected. It was an expansion. And so the graph goes up. And what you'll see here is that it's, you know, it's way above zero. So on average, the stats have been positive. And I put that in essentially because at the moment, the stats relative to expectations in the UK, as frankly for most of the world, as economies come out of hibernation, is in pretty good tenor. Now, valuation. So what I've done here is put a long-term metric. We could have used all sorts of metrics, but what I've done is I've used this metric called the CAPE, which essentially what it does is it takes 10 years of earnings forecasts, adds them up and divides by 10 to get to a figure. And so what essentially it's trying to do is think about what earnings are over a broad period to give an indicator of value. Now, obviously, if a market is, or if a share is growing very fast, then obviously that understates the valuation. But why I put this in is just to show that the UK actually is in a rare position. It's, along with Japan, it's yellow dot, so the nowcast is below the median. So again, the valuation gets a tick. And then, as we all know, positioning is important for markets. And what I've done on the bottom chart here is just extracted, if you like, one of the sort of gold standard surveys of this, which is the Bank of America survey, and you can see there again this positioning, because it's below the line, is pretty skinny in UK equities because really of what I think's been in the rear view mirror. Now let's think about that rear view mirror, because it is quite something, and I've had some fun here with a few headlines, and you know, I think we've all tried to get it out of our mind, but actually, if we went into TARDIS back in time to March 2020, it was quite an ugly time for the UK. And I've extracted one headline, which when I read it, if I'm honest, gave me quite a funny feeling in my stomach, really. Sterling hammered as London prepares to go into lockdown. You know, a lot of things were beginning to look as if they were spinning out of control in the UK at that phase. And whilst hindsight is a wonderful thing, I think, you know, generally one would see that perhaps the UK apparatus perhaps wasn't as sure-footed in that early phase as some other countries. So that's if you like the sort of history, layered obviously also on Brexit, which had obviously been a bit of a sword of Damocles hanging over business decisions and international investors' decisions from the period 2016 to then. But then obviously roll forward to 2021, and obviously it wasn't a straight line, but actually what we've seen is we've seen a thin deal agreed with Europe, a Brexit deal. And again, I've taken a little headline from the FT, and it's this Nissan headline. And why I've chosen that was that those of you with long memories will remember in 2016, around the time of the referendum, it was Nissan who actually made quite a song of dance over whether they'd be committed to the UK in certain circumstances. But, you know, this is the 22nd of January. Here we have the chief executive of Nissan saying they're prepared to commit to the expand the range at Sunderland. So that's good news. And obviously, what is also great news is that Kate Bingham and her colleagues have played something of a blinder in terms of how they've layered the orders of vaccines. They've just nailed it. And that, in combination with our incredibly well-drilled NHS, means that I can extract these headlines. So the first one is from the New York Times, and the second one, I'm afraid my O-level German doesn't slightly stretch that, but I'm told that Beneiden equals envy. So this is a headline taken from Das Bild saying, we envy you for all the obvious reasons. And, you know, I labor that and had some fun because I really want to emphasize actually that the UK has got its mojo back, is on the front foot and is looking up, and we need to recognize that definitely. Because the next slide, and I would only give anyone one guess on this, you know, the next slide is obviously that it's not just, you know, me saying it's interesting. You know, all these companies have actually been either approached or taken over by corporates or private equity. People are chomping into the value in the UK equity market at the moment. Now, in terms of sort of thinking and bringing this all together, I mean, I would say the sort of impetus behind the UK equity market, you know, relies on a number of sort of areas. You know, yes, there's the Brexit deal. It's thin, admittedly, but it allows business to plan. And, you know, for the banks, and in reality, one of the reasons the UK equity market was a bit dull in the early, in that jaws, which I showed in those early slides, is because we've got quite a heavy representation in banks, which were obviously licking their wounds of the last crisis, but they entered this crisis with rock solid capital ratios, and it allows them really to, as we exit this crisis, and we've already seen that, it allows, let's say, the likes of NatWest to set out a 3-year route map of dividends, and also allows the opportunity to buy back some of the government stake. You know, these are very different beasts from, if you like, the rear view mirror perception. Then in terms of the UK, again, one of the reasons why the UK was something of a Cinderella, looking back over the last few years, was that we do have quite heavy representation in some of the commodity plays. So I'm thinking some of the miners, the likes of Anglo American, or the oils, the likes of Shell. We're now obviously, as the prospect of a strong recovery, pent-up demand in a way that it is also fiscally driven, so quite resource intensive in this early phase, is driving strong commodity prices. We also have a number of really cheaply priced, if you like, reopening plays, because let's say Associated British Foods, which we put here, it's obviously a conglomerate, but one of its big earnings drivers is Primark. And, it's absolutely certain, I think, that, come April the 12th, when shops open, we'll be looking at videos of people queuing to get into Primark. These are businesses which were trading strongly before and will trade strongly exiting it. We then have businesses which also compare very well internationally in terms of their global valuation. And also I'd say to you that actually the UK is amongst the leaders in how it's calibrated its approach to what's now called ESG. We've long thought of it as sort of, if you like, responsible capitalism, but this idea that actually to craft the level of profits, you have to calibrate it in a way that works for all stakeholders. So there's a lot to like about the UK. And I put here just a few summary valuation metrics for a couple of comparators, but I won't belabor that because time marches on. Then in terms of one of my final slides, it's really to say that how we're expressing this. If you buy into the argument that the UK equity market is indeed cheap at the moment, the UK equity fund is a flexible fund. It has multiple themes driving the returns over time, which I think is the right approach. And if I just elaborate on a couple of those themes, perhaps sustainability, which is an important one. So Mondi, for example, there, you may be aware it produces all sorts of papers, such as the paper one uses for printing out stuff. It produces pet bags for high-end pets. It produces those cement bags, but actually nowadays what it's also trying to do is work out a nexus that obviously reduces plastics, reduces paper usage. And one good illustration of which comes from a press release in the last 24 hours is actually Mondi has worked with Tesco to take their corrugated paper waste from their warehouses and reprocess that into paper bags that in due course you'll be able to buy in any Tesco here in the UK, and obviously they're doing that already in their operations in Poland. Why I say that is it's obviously good for Tesco, reduces its carbon footprint, which is important. It's good for obviously the UK's carbon footprint, but actually it's also good for Mondi because it changes the nature of a conversation that Tesco might have with Mondi, away from I want this for that price, to actually I need this product with this specification. It's more of a partnership, allowing a higher gross margin. And so sustainability is really important. And we're, for example, have reported today, and there again, it's a really interesting company because what they're doing is they're helping mining companies reduce their carbon footprint by reducing energy and water usage, which is obviously crucial because of a lot of mines are in areas that are resource constrained, and therefore they have competing demands from the host nation and we're really is in the sweet spot of that. And then the final theme I might just emphasize as time marches on is Darwinism. So Darwinism, what we're really trying to emphasize here, and obviously it's absolutely crucial thinking about the exit from this COVID nightmare that we've been through, is that the reality is, sadly, that the market structure entering COVID is going to be very different from that exiting it, sadly. You know, they're going to be the companies that are going to emerge on the front foot in a muscular way, ready to crunch the competition, and they're going to be the walking wounded. And so a lot of what we've been trying to do at Majedi is, in our dialogue and engagement with companies, we've been, you know, looking to really think about how companies are calibrating their strategy so they're on the front foot, ready to do 2x whatever the market might offer them. And, you know, Marshall's is right there. Some of you may know the product. It's actually a remarkably broad product range, very clever company. One of their big USPs is obviously speccing into the architectural spec right at the beginning of a project, so that it's very difficult for a contractor to break that spec. But the reality is, you know, their competition is a pale imitation now of what it was, you know, 2-3 years ago. Or think, you know, another company we own on this theme is something like Greg's. You know, sadly, again, if you think about much of their competition, it's going to be pretty hollowed out by this for all the obvious reasons, because, you know, about 50% of the market is in either single sole traders shops, or perhaps chains of 4 or 5. And obviously these types of businesses have had a very, very tough period through the relatively unpredictable opening and closing in the various lockdowns that we have had. So what I've tried to do here is put, if you like, the case for UK equities. You know, I feel strongly we're at a really interesting juncture. If you agree with that, there are obviously multiple ways to play UK equities, but I do think one of the very interesting ways to play it is through Majedi, the Majedi Investment Trust, which has a really nice mix designed to play this, with obviously a sidecar also in global and a hedge fund. So I might pause there and move back to the moderator for any questions which William or myself might look to field.
Thank you very much, James. Thank you, William. Yep, we have some questions coming in indeed. The first one is, what is the sort of active share of the portfolio, and sort of how is it as well, sort of factor-wise, tilting between growth and value as a blend currently, and sort of where do you see the outlook for that tilt?
Yes, so thank you for that question. Yeah, so the active share is approximately 70%. In terms of the growth versus value, it is relatively balanced. So we look at this through a number of lenses. There's a provider called Morningstar. We use FactSet, all designed to look at the various metrics, and we construct a style skyline. And then the interesting thing is that actually, you know, it's a relatively balanced picture across it, because we run multiple themes, because we think it's the right way to do it. More recently, we have been, as of the last 12 months, we've been, you know, gently adding to both growth and value. and we've done it in a reasonably timely manner, and you can see the evidence of that is that, you know, pretty much across the piece, the Majedi funds have outperformed over this period.
Thank you. And again, in a similar theme, but this one looking at market cap, sort of how is it in terms of general split currently for the portfolio in terms of large, mid, and small overall?
Yes, so we have within, and remember I'm talking about the UK equity fund here, within the Majedi investments portfolio. So we have approximately 8% in small cap. We're lucky enough to have two managers there, John King and Emily Barnard, who you know, are very good in this space, and you know, are looking to add value in small cap. But you know, we're not biased to we don't have a small cap bias.
I think I quite answered that question quite succinctly. We have a couple more questions, keeping on the UK theme. One very topical is that tomorrow we do have the budget announcement. So, and with that will come a clear fiscal roadmap for the UK, but also the propensity for raising taxes. So, I mean, given these two factors, how do you think which one will sort of supersede the other in terms of increasing their valuation for UK equities? And as a tack-on point to this question as well, what about the impact of the breakup of the unions, or this perpetual Scottish independence and Northern Ireland question? Do you feel that is dragging on the equity markets in the UK as well?
Yeah, so you know, just as I was looking at long-term graphs when, you know, I was thinking about the UK equity market, I think it's appropriate to look at taxation on a long-term perspective, because, you know, corporate taxation's obviously been on a march down from sort of 35% to approximately 18%, and now looks to be on a march up to of the order of 25%. From an equity market perspective, you know, it doesn't really matter whether Sunak decides to announce that tomorrow or in September, because I think, you know, the reality is, you know, the direction is clear, and I think if you look at the direction generally, you know, it's probable in the States corporate taxation is going to go up. So, you know, I think we are seeing, you know, just as regulation is, if you like, sort of competitive on the way down and up. So if you look at the banks, for example, so in terms of corporate taxation, you see, if you like, competitive dynamics move up and like that. So, you know, I think we're going to see corporate taxation move up. I'm not sure it really matters whether it's announced tomorrow or in the autumn. It just feels like that's going to happen. And I don't think it's, you know, is dramatically market moving. It's obviously sort of marginally negative, but I think people sort of really tend to know that. You know, Scottish independence and the union. I think it's definitely something one has to think of as a negative. But I think in terms of quantum, I don't think it's anything like the negative, which, leaving politics aside, you know, there have been periods over the last 4 to 5 years where there was thought that there'd be a Labour government, which, given the then head of the Labour Party, would have been something that the UK equity market and international investors may not have welcomed. And you know, this issue in you know, with the union, I think is something which is a negative, but I'm not sure it, well, I know in my own mind it doesn't detract from the attraction of the UK equity market, because not only do you have domestic companies that are cheap, but also you have many international companies that are cheap.
I guess then, do you foresee a sort of a singular catalyst to start the rebound of the UK equity market, or like a sort of smoking gun situation? Or is it more of a sort of slow burn upwards thanks to a sort of back the factors you pointed out before?
Yeah, I think it's going to be, you know, a combination of things. I think it's going to be, you know, the realization that we can exit and get the economy, you know, back to some kind of normality earlier than our peers. I think that what you're going to see is you know, reasonably strong recovery and profitability, pretty supportive fiscal policy, obviously monetary policy. And I don't think there's going to be a single catalyst, but there are just a number of things which I think will drive this reduction in what I see as to be a valuation gap.
And then I guess speaking of sort of valuation gap trend as well, obviously there's an element of rate sensitivity of that, but that's a global issue as well. So what's the overall position of the trust to sort of interest rate sensitivity?
Yeah, the overall position of the trust is, if you take the premise that long-term rates have obviously been on a long march downwards, and if the questioner is asking, so what is the sensitivity to you know, 10-year rates, you know, pivoting up, inevitably there is some sensitivity, and it will depend how quickly, if that does come to pass, it happens. But you can see in the asset allocation, which William's chart, you know, showed, you know, at the beginning, you know, the sensitivity is probably going to be greatest in the US. And why I say that is because it's there where the growth, the hypergrowth angle is most represented. So if long-term rates rise more than people expect, this is the point where actually longer term cash flows become perhaps less valuable, and near term cash flows become more valuable on a relative basis. And so I think the trust taken in the round is relatively well placed to that. We also, through our hedge fund, the Tortoise Fund, also have a relatively cautious positioning and a number of hedges in place there.
Good that you mentioned the Tortoise Fund, because you have a couple of questions on that in particular. First one being, what is sort of the role of a hedge fund in a portfolio that is majoritively global equities?
If I start on that possibly, and James takes over, I think one of the main reason why we've invested in the Tortoise Fund is because, in effect, what it is a long-short hedge fund, or long-short equity fund that takes down the volatility over the equity cycle. And even though it's been a little bit disappointing before the last year, it did take the volatility is definitely reduced for our returns by having that the hedge fund. I should also mention that we do have long-term debenture, which is historical. It was taken out in 2000, and we think that it's important actually we take a bit of equity volatility down there. But the other side of that is that the managers of the Tortoise Fund have been very adept at moving their net long and short positions, so that when the market runs, as it did last year, and you go on to the next page, you can see that the performance of that hedge fund has been very strong. So you see over the last 12 months, it's up 22%, which is well in advance of the global markets, and also over the last 6 and 3 months. So those are the reasons why we retain the Tortoise Fund, and it's a key differentiator for us as well.
Are you also able to put some commentary on its recent performance? I know it has done 25% over 3 months. Is quite a stunning figure. So I just wondered if there is some rationale there.
Yes. In terms of the reason behind that, as William said, in essence, this is run by 2 managers in the context of Majedie, Matt Smith, Tom Morrison, supported by Ting Owen, and they have done an incredible job in really thinking through the dynamics of how COVID was going to progress through the economy and how we might exit. And that requires a lot of science, a lot of going through the data of things like the Lancet and some pretty technical stuff. And they came to the firm conclusion that actually we would be able to sort a vaccine. That would mean that actually this crisis would be in the rearview mirror relatively quickly. And for some of the most affected industries where competition is falling away, actually those that survive were going to do remarkably well. It was also going to be inflationary, and so they've had big positions in some of what people call the reopening plays. They've had big positions in the commodities. They've had big positions in the banks, all of which have done very well. And as Williams said, more recently, they've also put something of a hedge on this this position in terms of the downside. So, I think they've really navigated this well. Obviously, every month is different, but those returns are stand high in any sample you might see in the hedge fund industry.
Sticking with the sort of non-UK allocations for Majedi investments, some questions come through about the fund management equity stake that the trust holds. The first one is sort of how do you go about valuing that stake, as well as, I think we'll deal with that one first. It's probably the most pertinent.
Okay, if I take that, we value the stake in Majedi Asset Management quarterly, and we did a review of this just under 12 months ago. So in effect, what we do is we take comparisons in the public markets, take a median of the PE multiples there. We then annualize the last quarter's earnings, which is very sensible to do for a fund management company because there's no seasonality. And then, so basically, we then take a 20% discount to the public median. We do the same for performance fee profits, because there are performance fee profits within Majedi Asset Management, but a 50% discount on those, and then a further 20% discount. And then finally, we take the surplus cash within the balance sheet, having taken it down by 200% of regulatory capital. So really what we're trying to show is take the last quarter's earnings to give a very up-to-date valuation company. I mean, I should say that the last revaluation was done on the 7th of February, so it isn't included in the numbers that I've shown you on the second page. It's a little bit higher. It's about 5% higher.
Mm-hmm. Thank you, William.
Thank you.
Also, I suppose question around as well, the sort of long-term prospects for the company. Not sure if you guys can give a corporate outlook on a private company, and also around its contribution to the trust dividend as well.
In terms of the dividend, it is a very it does contribute a large amount to our dividend, to just over 50%. So that has been very helpful and is one of the main reasons why we as Majedi Investments have have a yield of over 5%. I should say that in the last year it was an uncovered dividend, but we're fairly confident that with the recovery, and we have 6 years of revenue reserves, so we can actually do a degree of this, you know. But I should say that actually looking forward is, given the recovery in markets, it's very difficult to judge how dividends are going to change in the next 12 months. And they probably won't get back to the level that we were talking about 12 months ago. But with the recovery in dividends, and also Majedi Asset Management's strong long-term performance, but more importantly, very strong performance over the last 12 months, we're confident, if those things happen, that dividend can continue. But so that's the background to the dividend.
Yeah, and then in terms of the long term, I mean, the long term for a fund management firm, the best indicator I would say to you is how it should be, which is, for an active fund management firm, is performance. And as William has said, actually we've had a good COVID, numbers are good, and that is a good lead indicator for the business.
Thank you, guys. Also, some other questions linked to the positive performance of the trust is sort of around the current discount. What are your team's opinions on it? And is there sort of any plans to make any attempts to sort of narrow it from the trust as well, and sort of the opportunity you may view it as being for investors?
Yeah, in terms of, no, we're not particularly happy at the discount is 17%. I mean, 5 years ago, we were trading at a small premium, and we also issued stock. We'd love to get back to that position again. In terms of what we do about it, I mean, I think as James just alluded to, is that our discount, I think, is a lagging indicator of past performance. And up until about 12 months ago, our performance had been disappointing for 2 or 3 reasons. I mean, one of them was actually we were overweight in the UK market, and 2, MAM had had a slightly rough period, and their assets had gone down. So those are the 2 main reasons why we'd underperformed. So I suspect that's one of the reasons why the discount widened out. And I think the other reason for the discount being wide at the moment is Aviva, who've held stock in this company for at least 5 years, have begun to sell down. They did own 13%. They now own about 7.5%. So there might be a perceived overhang in the market that Aviva are selling down their stake. But they've reduced it by half in the last 4 months. So we'd like to think that with a combination of stronger performance, particularly with the UK equity market driving it, the discount will narrow. But we have used share buybacks in the past, but with that overhang, we think it's rather pointless to buy shares back currently, because we know there's 7% out there much prefer to be held by long-term investors rather than just buying shares back for cancellation.
I'm conscious of the time as well. So I'm going to see if I can just fish out one positive question. I guess you mentioned, just to bounce off the dividend, a quick one for you to roll off before we finish is, what is the outlook in particular for UK dividend recovery, given the new income peer group you're in?
I think I'll leave that to James.
Yeah, I mean, obviously, dividends fell, approximately 30% during COVID. What I would say to you is that actually, for many companies, it gave them an opportunity. Obviously, it was a very tough time, but it also gave them opportunity, if you like, to sort of recalibrate their dividend policies. Because a number of companies have been over distributing. So actually the base from which we now restart or grow our dividends, depending on the company in question, is a much more sound one. And remember, we entered this, the UK equity market entered this with a sort of premium dividend yield. So I think if you take, many companies, they offer, a good absolute dividend yield over the medium term, which is good relative to many equity markets and also good to fixed income. And obviously, let's take one of the biggest companies in the all share, which is Shell. Now, Shell cut its dividend back in April of 2020 by 66%. Then in the third quarter of last year, it actually raised its dividend by 4% and has indicated also that it's going to raise its dividend by 4% for this year, and is looking to move to that kind of sort of timbre in terms of the rate. So, that's just taking one of the largest companies to give you a sort of an indicator. But the big thing, I said, we're much more sound footing in terms of how dividends are calibrated now. So I think we're in good shape.
Thank you, guys. I am conscious that we've just overrun our time, and I think I will end it on that rather positive note. So again, I would like to thank you, James and William, for your fantastic presentation. And I would also like to remind all of our attendees that our next session on BlackRock Latin America starts shortly. If you have registered for that, you should already have a placeholder in your pattern containing a personal link in your diary. If you haven't, there is still time to register. And if you go to the article on our website's homepage, you will be able to find a link to register for that presentation. So, and again, I would like to thank everyone for joining us as well. And I thank again James and William for taking the time to talk to us today, as well as an excellent presentation, what I think we'll all view as quite a bullish outlook for UK equities, hopefully Majedi Investment Trust as a result. So, again, thank you all and goodbye.
Thank you.
Thank you.